Okay, so we might as well get started here. What we'll be doing today is discussing 2 of the exercises and 1 of the problems from chapter 6, and then we'll go into a review of the material for the exam, which will be next Tuesday, and that'll be from chapters 3, 5, and 6. Excuse me. So the chapter 6 problems, there is this Word file in our 32521 folder as a subfolder in the week 9 materials. And this just contains the 3 problems that we'll be going over today. Okay, so exercise 618 dealt with depletion, which is extracting some sort of substance from land. In this case, I do believe it was some sort of mining mineral rights, or it was coal reserves in this case. So land was purchased the mine was purchased for $600,000 with the estimate, and there would be some sort of, like maybe an engineering estimate that would take place about the time of the land purchase, which would determine approximately how many tons of, in this case, coal we have to extract from the land. And that'll be our depletion rate, will be to take the total cost of the mine divided by the number of tons that we believe, per the estimate, would be able to extract from the land. And the estimate, based on the problem data, was 40,000 tons of coal reserves. So as a per ton depletion rate, we'll have $600,000 cost of the coal mine divided by 40,000 tons of coal to be extracted, gives us a depletion rate of $15 per ton. So we'll be taking a depletion expense for the rate of $15 for every ton of coal which is extracted during the year. If something happens with an estimate where we have to update the estimate, that would be done in the future, but the problem only asks us to calculate the depletion for years 1 and 2 as part B, and as part 1 to calculate the depletion rate, which we just did at $15 per ton. So B not only asks us to calculate the depletion for year 1 and year 2, but to show how that depletion would be represented, how it would be entered into the horizontal statements model that we've been using in our text here. So the initial, they gave us an initial entry of $800,000 cash and $800,000 common stock. So to record the purchase of our coal mine, that would be the second line here, which would be to decrease cash by $600,000 and to increase coal reserve. coal reserves for $600,000, which is an asset, of course, long-term asset. So the depletion for year one and the cost of that coal mine would also be in the statement of cash flows, would be a $600,000 cash outflow for investing activities. So depletion for year one, the problem data told us that the company extracted 15,000 tons of coal in year one. So we just take the total, the actual tons of coal extracted times our depletion rate calculated in part A. So $15 per ton times 15,000 tons extracted gives us year one depletion of $225,000. Would be recorded as such here in the horizontal statements model. And it would be no effect on cash, decrease of $225,000 to the coal reserves account, and an increase in expenses, which of course in turn decreases retained earnings. It would be depletion expense would be the name of the account. And no resulting change in cash flows, because that depletion, again, it has nothing, there was no cash involved. It was just an allocation of the cost of that coal mine among its useful life. And this time we used an estimate based on units of production, which is the general method for depletion. Okay, so for year two, the textbook tells us that we extracted 18,000 tons of coal in the mine for year two. So we use our same depletion charge per unit calculated in part A, multiply that by the actual tons of coal which were extracted during the year at 18,000 tons. Multiply the two together, gives us a total depletion for the year two of $270,000. So same entry as year one, just different figures. So $270,000 reduction in coal reserves, $270,000 of depletion. If we were to calculate the balance of our coal reserves account for our year two balance sheet, we would start with the $600,000 cost, subtract year one depletion and year two. So on the 12/31 year two balance sheet, we would show coal reserves at $105,000, which is net of the 2 years of depletion. So we've already hit 33,000 tons of coal extracted. So we might have to do some more estimating if the company does believe there is more than 40,000 tons in total to extract. Then we might have to go forward and revise our estimates, but that would happen from the point of new estimate forward. So that takes us through depletion, which was exercise 618, excuse me. Next was 620. And 620 deals with laundry list of costs involved in purchasing an existing business and how much would we allocate towards assets and how much will we allocate towards goodwill. So our problem data tells us that our company's Arizona Corporation, they acquire an existing business called Data Systems. The cost of the acquisition was $320,000 cash and assumption of the liabilities. The liability assumption is also deemed as sales price. So the total amount paid, in essence, for data systems by Arizona Corporation is $360,000, not just the $320,000 cash. Because assumption of liabilities, it is sales price also. So relief from liabilities for data systems is income. Just like debt cancellation is income to individuals. Same basic concept. So the total price paid, which would be cash price plus liabilities assumed, less the fair market value of the assets, will be what's goodwill. Well, they gave us what was in data systems books. In data systems books, there was tangible assets of $260,000, liabilities of $40,000, stockholders' equity of $220,000. We don't care what's in the books. What we care is what an appraiser says. And that's the very next sentence of data in the problem, is that the appraiser appraised the fair market value of the tangible assets at $250,000 at the date of acquisition. That is what we care about. With the fair market value of the assets. So the total purchase price less the fair value of the assets yields the goodwill. So really what Arizona paid above and beyond the price of the assets just for the privilege, I guess you could say, the intangible privilege of doing business as data systems, because apparently there's an existing reputation, probably taking over the existing customer base, and there's some intangible benefit just to doing business as data systems, and that's what's deemed goodwill. And that is an intangible asset and is not expensed through amortization, unless something were to happen to the reputation, so to speak, of data systems. Maybe they have a bunch of systems that just start crashing and no one will buy data systems equipment anymore. Then you might have an impairment of goodwill. And at that time, there is expense taken. Otherwise, there is not. So the book gave us in Arizona Corporation, the first entry, which just was the existing figures from the book at the time of the transaction. So we had $450,000 cash and $450,000 equity. The second line here shows the acquisition of data systems by Arizona Corp. And so that was a decrease of $320,000. That represents the cash paid. We also assumed the liabilities. So we'll add $40,000 of liabilities. We added $250,000 of assets, which is the fair market value at the time of purchase. And the balancing figure is goodwill at $110,000. In terms of the statement of cash flows, the only item to be dealt with on this transaction is the actual cash price paid of $320,000, and that is an investing activity outflow from investing activities. So that is goodwill. Okay, so the problem we look at is 323, and that deals with assets purchased and depreciated. And we'll depreciate using the three different methods of depreciation that we studied in this chapter. And that was straight line, double declining balance, and units of production. So our facts of the problem were that our company, Banco Inc., is a sporting goods manufacturer, and purchased a machine on January 1st of year one for $70,000. Involved in that machine was we had to pay a delivery cost to get the machine to get in its proper place and intended use. We not only had to pay a delivery cost of $3,000, we had to pay an installation charge of $1,000 as well. So those are all costs involved in getting that machine ready for use by Banco Inc. in its operations. And those costs are all part of the cost of the equipment and will be depreciated rather than just expensed in the year incurred. So the cost of our equipment in the books, if we had, our equipment account, would show an initial value balance of $74,000, which is the actual purchase price of the equipment, plus the delivery cost, plus the installation charge. So requirement A asks us to determine the amount of depreciation expense. And this is for both year 1 and 2 for each of the 3 different methods. So for part A, it is straight line method. So our straight line formula is cost minus salvage value. That quantity divided by number of years of useful life. So the problem data told us that our equipment has an estimated life of 5 years. So the 5-year portion is what we need for straight line method. And it would be what we need for double declining balance as well. So $70,000 is cost minus salvage value. That figure divided by 5 years of useful life gives us a depreciation rate of $14,000 per year. So year 1, 2, 3, 4, 5, the depreciation entry will look exactly the same. That is straight line method. That's why it's widely used. It's so easy. So year 1 depreciation, year 2, year 3, year 4, year 5, $15,000 or $14,000, excuse me. But they only asked us for years 1 and 2, so that is our result is $14,000 depreciation for both years. So part B, double declining balance, a little bit more complicated than straight line. The basic formula, the solution did give us right here. It is that our asset cost minus our accumulated depreciation at the beginning of the period times the quantity of 2 times the straight line rate. Here it's expressed as a decimal rather than as a fraction, but as a fraction, your straight line rate would be 1 over 5 years. So straight line rate could be expressed as 2 over the number of years of useful life. Excuse me. So cost minus accumulated depreciation at the beginning of the period times 2 times the straight line rate gives you your annual depreciation. You do have to keep an eye on the accumulated depreciation using double declining balance because you do not want to exceed, it'd be $70,000 would be your maximum accumulated depreciation. Once you hit that point, you are done. So double declining balance, you do not usually get as many years of depreciation entry as you do using straight line or units of production. So year 1 calculation for double declining balance, being that we have no accumulated depreciation, the beginning period is relatively easy. And that is that our cost minus accumulated depreciation will just be $74,000. We ignore salvage value until the last year of depreciating the asset. And at that point, it is a plug rather than multiplication as we're having, as we're seeing in year 1 and year 2. So our year one depreciation, $74,000 asset cost minus 0 accumulated depreciation times 2 times the straight line rate. Straight line rate was expressed as a decimal of 0.2, which is 1/5. So if you wanted to express that as a fraction, 2 times the straight line rate, you can say it's 2/5. Comes out exactly the same. So $74,000 times, 2/5 would be 40% times our $74,000 of cost gives us our annual depreciation of $29,600. This amount is our accumulated depreciation at the beginning of year two. So that's why we see that figure right here as well. And then for year three, our accumulated depreciation would be the sum total of depreciation for year one and year two, if they asked us to do year three, which they did not. So year two, double declining balance depreciation would be the $74,000 cost minus $29,600 accumulated depreciation as of year two. So that result is $44,400 times 2/5, which is 40%, which gives us double declining balance depreciation for year two of $17,760. In both cases, more than our straight line, but we would hit a point in double declining balance where our depreciation would be below the straight line rate. So it does happen. It has to. So the assumption with double declining balance is that this equipment will be utilized much more in its early years of life as opposed to its later years. Later years, it might be out of service more because it needs maybe some technology updates, some retooling. It's just not working as well as it did when it was freshly manufactured. Okay, so unit part C, units of production. We have to utilize some more data given to us in the problem, and that is that our company believes, Banco Inc., that of the equipment purchased, the equipment should be able to produce 140,000 units of product. So units of production formula is given right here in part 1. And that is that we do involve our salvage value in the units of production. So it's cost minus salvage value divided by the total estimated units of production over the life of the equipment. So we're expressing life units of production as a total number of units. We do believe this piece of equipment is going to be able to produce. In that case, 140,000 units is what the estimate was. So our formula becomes $74,000 asset cost minus $4,000 salvage value. That result divided by 140,000 estimated units of production out of this piece of equipment. So we get a depreciation rate very, very similar to what we saw in the problem dealing with the depletion, as it is the same basic method. So 50 cents per unit will be our depreciation rate times the actual units produced during the year. Just like with double declining balance, we need to keep an eye on accumulated depreciation as we go through the life of this asset. Once accumulated depreciation reaches that $70,000 mark, we need to stop, regardless of whether the equipment is pumping out additional units of product or not. At that point, you would either have to revisit the estimate or just stop depreciating entirely. So cost per unit was our 50 cents per unit times our current units of production given to us in the problem underneath the table of data. As during year one, the machine produced 36,000 units. So to calculate our year one depreciation, 50 cents per unit was the rate we calculated above, times 36,000 units of produced using this piece of equipment during the year. And they would all have some sort of a unit counter as part of the equipment. Just like any good, something like a copy machine. Our copy machine takes count of the number of pages that we've copied. This equipment would count the number of units produced. Same basic difference. So $18,000 would be our depreciation for year one. A little bit over what we saw in straight line and a little bit less than what we saw in double declining balance. Again, units of production actually does, if you have a machinery that actually puts out units of product, that's probably the way to go, is to use units of production depreciation. The main catch is doing the estimation of how many units do you believe this product will be able, or the equipment will be able to produce. That's where it gets a little sticky. And these are just estimates, regardless of method used. So year two, we got a little bit more out of the equipment in terms of units, 38,000 specifically units produced using this piece of equipment. So same depreciation rate calculated in one times our number of units produced. Same paragraph of data underneath our table tells us that in year two, our machinery produced 38,000 units rather than the 36,000 in year two. So it was used for a little bit more manufacturing than in the year before. So 38,000 units times 50 cents per unit. Our depreciation would be 19,000 for year two. So again, this will go based on, the number of units we produce in year 3, 4, and year 5 will likely be a plug figure to get accumulated depreciation up to $70,000. Or there may be some revision of estimates that happens sometime in between years 2 and 5. It could happen. The book did discuss. Okay, so that's our problems that we were going to discuss for today. We'll do a quick run through of our 3 chapters to be involved, and we'll talk about the exam here real quick. The examination is chapters 3, 5, and 6. Format, same as what we saw before, 30 multiple choice questions. We will not meet next Tuesday, the 30th. Instead, the examination's available in Sakai. I will have the examination up sometime tomorrow. I am aiming for tomorrow morning. And I'll send you a course announcement when I have that exam ready for you. And it's just taken any time between when it's released and the absolute due date is by our next class, by 8 a.m., 9 a.m. Thursday. Let me make that 9. Maybe do 9. By the start of class next Thursday. So 9 a.m. it is. That just makes life easier. So for 3:30, review the chapters for exam 2, and then Tuesday, March 30th will be Again, at class time, we do not meet. We will just be doing the exam during that time. So our 3 chapters involved were chapters 3, 5, and 6. We'll just do a very quick run through here of our 3 chapters. Our first one was merchandising businesses. This is where we discussed, this is the kind of examination. Well, we'll talk about, the merchandising businesses. Those are in the business of selling goods rather than providing services, as we saw in, basically chapters 1 and 2. We have a couple of different terms that were involved in this chapter, and that was merchandise inventory and cost of goods sold. So our merchandising businesses buy merchandise from suppliers, mark those goods up, and sell them to the end customer or to another wholesaler, possibly. So merchandising businesses include both retail and wholesale companies. You, as a merchandising business, can sell your product to another reseller. And the main difference there is sales tax. If you sell your product to another reseller, you do not charge them sales tax. Sales tax is charged on the very end buyer, the end user. So we have product costs, we have selling administrative costs. Our product costs are those costs, purchasing inventory, doing anything to that inventory we need to do to get it ready for sale. Maybe pricing it, any kind of stickers, any kind of labels, things like that would be involved in getting goods ready for sale. So selling and administrative costs are costs that are not inventory costs. So basically selling and administrative costs are also called period costs. So we use what's called the perpetual system. We do not cover in the textbook what is called the periodic system. That is way more complicated than what we need. So we are, with every purchase, using the inventory account. With every sale, cost of goods sold is being reduced. The inventory account is being reduced. So the perpetual system is what most retail establishments use nowadays, the bigger ones. And that is because of the advent of barcode scanners. So beginning inventory plus inventory purchase during the period gives us a figure called cost of goods available for sale. So during the period, the cost of goods available for sale has either been sold or is still in inventory. The cost of those goods that are still in inventory will remain in the inventory account as an asset. So merchandise inventory, the ending balance would be our ending balance of ending inventory. That figure would be shown on the balance sheet as just that, merchandise inventory, a current asset. The cost of the goods which are sold for the year goes to an account called cost of goods sold, which is an expense included in the income statement. So the difference between our selling price and our cost of goods sold is what's called gross margin or gross profit. It goes by a number of different things. Those are the 2 most common terms. Basically, what this figure means is that how much did the company generate in earnings by just buying and selling product. If you don't have a positive figure here, there's something wrong with the business. So from gross margin, selling and administrative expenses are subtracted, which will then yield net income. So our income statement would have some additional, basically subtotals involved rather than the income statements we'd seen from chapters 1 and 2. So yeah, the perpetual inventory system is what we use in chapter 3. It's what we use, period. Inventory account, as I mentioned before, it's continually adjusted through the period for each item purchased and each item sold. And that's where computers come in handy, because to do this by yourself would be an absolute nightmare. So that's why companies have inventory management systems. And basically that's all controlled using barcode scanners. That's how the units, the specific product sold is identified, and then the costs are also entered into that system, and that generates our figures for cost of goods sold and for ending inventory. So inventory balance will be increased for each item purchased and decreased for each item sold. Periodic system, however, you go through different accounts and you adjust your inventory at the end of the period. So we did an example through the book of purchasing inventory using cash. It is an asset exchange transaction. One asset increases inventory, another asset decreases, in this case, cash. And that is if you purchase inventory with cash. If you purchase inventory on account, you do not have an asset exchange transaction because you have accounts payable involved, which is a liability. So selling inventory, again, we do have two different transactions to record. One will be the recognition of sales revenue, either an increase to cash if inventory is sold for cash, or an increase to accounts receivable if inventory is sold on account. So you have to look at the wording in the problem in order to determine which account the flip side of the transaction is from revenue. So regardless of sales from cash or sales from on account, you will have an increase to your sales revenue account, which again is an income statement account. So we have a second part of the transaction. Whenever we sell goods in the perpetual system, we not only have the entry for the sale of goods, we also have an entry to record the cost of goods sold. So the problem tells us in this case that our company had $8,000 cost in the units that were sold in the transaction, the same event. Our $12,000 of sales cost the company $8,000. So in terms of gross margin, we had 12,000 minus 8,000, or 4,000. So that entry is a reduction to inventory and an increase to expense, namely cost of goods sold expense. And if you do note, statement of cash flows effect is 0, because the cash flow happened when we paid for those goods. So selling expenses, again, they're not part of the calculation of gross margin. Selling expenses might be things like our advertising, our rent, utilities, salaries to our sales personnel or management, just any other expenses outside of the cost of acquiring our goods that we're selling. So we have also purchase of land to locate a future store. That was a transaction. So our 5 transactions given to us in our problem, if you're following in the book, we are on the top of page 98. So this is Exhibit 3.2 from Exhibit 98, or Exhibit 3.2, excuse me. So our income statement is not just income minus expenses. we have to do subtotals when we have a merchandising business. So we start with sales revenue, subtract cost of goods sold. That result is labeled gross margin. From that, we subtract our operating expenses, selling and administrative expenses. And we only had the one of $1,000, giving us our net income of $3,000. On our balance sheet, if you totaled the merchandise inventory at the end of the period, there are only two transactions to it, and that was the purchase of goods for $14,000 and the cost of goods sold for $8,000, giving us a merchandise inventory of $6,000 at the end of the period. And our operating activities, note that our total amount of inventory is an operating activity expenditure. And that's because, yes, we paid for all of our inventory. It's not all sold, but we paid for it all. And statement of cash flows cares about what cash has come in and what cash has gone out. So we do have a net cash outflow for operating activities. So in this case, nothing to sound an alarm about. It's just that the business is getting started. We had to purchase inventory. It happens. So our transactions that can be related to purchasing inventory, go to a Walmart, you always have people returning items. So you do need to calculate and account for returning inventory or receiving purchase allowances. And we talked about this in the past and talk about it again here real quick. Say you receive some goods from your supplier and they come in damaged, or they're not exactly what you ordered. You can negotiate with that seller or the supplier and tell them, I will accept these goods, but for a reduction in my bill. That is a return, a purchasing allowance. And the same thing can happen on the sales end as well. So that's a sales return allowance. So you can take purchase discounts, incur transportation costs. We just saw this in chapter 6. And inventory shrinkage, especially seen in enterprises such as like a supermarket, or for clothing stores if you have merchandise inventory that is, out of season, out of style. Then you can have inventory shrinkage there, where you either have to just give it to Goodwill or sell it for a very deeply discounted price. So we again are going to purchase some inventory. This time we're going to purchase it on account. So inventory purchased on account increases inventory, but also increases accounts payable, which is a liability. So inventory purchased for cash is an asset exchange transaction. Inventory purchased on account, however, is an asset source transaction. We did not have a second asset affected. Instead, we had a liability account affected. So how purchase returns and allowances affect our accounting records, we do have to, and this time we are on the purchase end of the spectrum. So JPS company purchased some goods. Goods weren't what we wanted, so we returned them. Turn them back to the seller. We don't want them. Even if you give us a discount, we don't want them. We don't need them. So those inventory items are going to come out of our inventory. So we will reduce the inventory account by the cost of those goods. And we also will reduce the amount that JPS owes that supplier by the same. So purchase discounts. This is where your company purchases goods and takes advantage of a cash discount period. So you're given possibly 30 days to pay for your merchandise. However, if you pay for that merchandise within 10 days, you are granted a discount. So this is on the purchase end of the deal. So JPS purchased those goods from transaction, or was it event 2, I believe. Event 2. Purchased $11,000 of goods, but returned $1,000 from event 3. So $10,000 of net purchases are involved, and JPS decides, yes, we are going to pay within 10 days. So again, that 2/10 The 2 is the percentage of discount being offered. 10 is the number of days between purchase date and payment that you have to pay for the goods in order to earn that discount. The N stands for net, meaning the net invoice is due then within 30 days. You do not have to take a discount. It's not all or nothing. You could decide, JPS could decide, you know what, we're going to take that 2% discount. Maybe we don't have the cash right now. We'll take the discount on half of the goods. And then the other half, we will forego the discount. It does happen. So again, it's not all or nothing. Problem data will tell you, how much of the goods were granted a discount. And that's a case where dates are often used in problem data. And you almost have to do the calculation yourself as to whether or not the invoice was paid within the 10 days or whatever the credit terms are. So what happens when you do take an advantage of a discount is that will reduce your cost of goods. So your inventory will be reduced by any discount which is taken as a purchase discount, and your accounts payable will also be reduced by the same. So event 4 is receiving the discount. Event 5 is paying the net amount to the supplier. Okay, transportation costs. Again, transportation costs depend on what the terms of sale were, and this is the bottom of page 101 in your text. There is FOB, free on board, freight on board. It's called a couple of different things. The terms FOB destination, FOB shipping point, those ID whether the buyer or seller is responsible for the goods. If a buyer purchases goods FOB shipping point, the transportation costs are on the buyer. They have to pay for those goods to be delivered to their location, and that would be part of the cost of their own inventory. If you are in the same transaction, the seller, then you will not have any transportation charges, and you don't have to carry insurance on the goods that are in transit. So if something happens to those goods in transit, it's on the buyer, because those goods were as soon as they're tendered for shipping, they're the buyer's problem. They're not the seller's problem anymore. On the other end, if the goods are purchased FOB destination, then they are the seller's responsibility until those goods get to the buyer. So that seller has to carry the insurance. Any damage done to the goods, the seller has to make good on that. And the seller would pay the shipping costs. And it would be an expense to the seller labeled as an account called transportation out, which is just a selling and administrative expense. And we did see a little bit of that we actually saw a revisit of that in chapter 6. So problem data might tell you what shipping terms are for inventory. And if the company paid the freight, then it's on you to label, okay, if I purchased goods FOB shipping point and I'm the buyer, then I'm responsible for getting those goods to me. I have to pay the shipping costs. And yes, that's part of my inventory cost. Okay, so again, we have sale of merchandise and cost of goods sold. Now, when you are the seller, is event 8. JPS is the seller, and they sold goods, apparently FOB destination, to their customers. So they had to pay shipping costs. Well, that's not part of their cost of goods sold. It's additional costs to that. So that would be a period cost called, again, transportation out. Transportation out, freight, shipping, whatever your accounting system uses. So that is an income statement account, an expense account specifically, but is not part of cost of goods sold. So they give us some selling administrative expense, interest expense, just to finish out the year. Inventory shrinkage. Again, if we have spoiled goods, if we have goods which go out of season, we would have inventory shrinkage, or damaged or lost from theft, lost goods misplaced. Then what we have to do at the end of the period is come up with a count of inventory, best done more like twice a year. We compare our ending balance, what our ending balance of inventory should be, with what it is. So we took a physical count at the end of the period, ran that through our inventory system. System tells us, okay, your ending inventory should be $4,100. We go into our accounting records, ending balance is $4,600. We need to adjust our accounting records to agree with what our inventory records show. So we would have a small adjustment of $500. Small in amount, but as a percentage, is it small? It's about 10% adjustment, so not that small. So depending on the size of the inventory shrinkage, whether or not to investigate further, that's up to the company. It's kind of a cost benefit analysis generally. So we reduce our inventory by $500. We would also increase an expense account, just like inventory shrinkage, something to that effect. And it would be a period cost in our income statement. They did a little bit of a gain and loss transaction, and that was selling our land that was purchased for a $700 gain. That gain is recognized outside of our regular items of our income statement, excuse me. As you note, that gain on the sale of land is included in non-operating items. So it's kind of taken away from operating income. This is not what our business is in the business of doing. This is more of, I don't want to say an extraordinary item, because that's used a little differently in accounting world, but it's an unusual item, I'll put it that way. So we want to present that separately from the result of our operations. Okay, so that was, we don't really need that. This is what a typical balance sheet would look like for a merchandising business, and a statement of cash flows as well. Okay, so net sales is sales minus any purchase discounts and any purchase allowances. The first example gives us a purchase discount. And the payment terms on this event were 110 net 30. And the merchandise was apparently sold, and we'll find out how much of the discount our purchaser takes advantage of in the next event. So we sold account on account. So we have accounts receivable involved, not cash. Merchandise that we invoice the customer $8,500 for. The cost of those goods to us as JPS company was $4,000. So under Perpetual system, we do have two events involved, one being this one here, the sale of the goods, which is increased to accounts receivable and increased to sales revenue. And the second being the recording of our cost of goods sold of $4,000. Reduction of inventory, increase to cost of goods sold. So we have a return, how returns are accounted for. The first thing we do is we credit the customer's account receivable. We reduce that by the amount of the goods received. And we increase an account called sales discounts and allowances. This would be sales discounts, which is, it's one of those contra accounts. So it would be presented separately on the balance sheet or the income statement, excuse me, as a reducing account to sales revenue. And our second part of our transaction is we have to take those goods and put them back into inventory. So we would reduce cost of goods sold by the cost of the goods that were received on return. And we would increase inventory by the same. And the problem tells us the amount is $450. So sales discounts, we collected the balance of our account receivable. So two transactions involved. The first one to recognize the discount. And they show us two different methods. What happens if the collection does happen before, within the discount period, and what happens if the collection happens outside of the discount period. If the transaction gets closed within the discount period, we have a discount to recognize, which is what happens in the first transaction, which is a reduction of accounts receivable and also a reduction in revenue, again, another contra account, and it would be sales discounts involved this time. And then the second transaction is the collection of our cash. How much cash do we receive from our customers to settle their accounts receivable? Well, what happens if we collect cash outside of the discount period? If that's the case, transaction 1, this one does not happen. Transaction 2, the figures would change to $7,500, which was the net that our customers owed us for the goods purchased. Okay, so we'll talk about common size financial statements. This is top of page 111. And this is just a very condensed form of our income statement, does not go into as much detail. So net sales is presented instead of sales revenue, sales revenue, sales returns and allowances, and sales discounts. So selling and administrative expenses would not be shown in detail as well by expense category. They would all be just totaled into one figure. So we have just a very short synopsis of periods, generally presented for like a short meeting. So nothing that a manager would have to study in much detail. Okay, so appendix we did not cover, so that ends chapter 3. So we'll get into 4 and we'll go over that just briefly here. No, I'm sorry, chapter 5. We skipped 4. Chapter 4 was on internal controls, and we didn't need to cover that. So we dealt with the receivables and inventory cash flow here. This is where we dealt with our percentage methods, percentage of receivables, percentage of revenue to determine how much bad debts or uncollectible accounts expense is. Percentage of revenue, probably the easiest method, but not necessarily the most accurate. So they do talk a little bit about net realizable value of accounts receivable. Of accounts receivable, this amount is how much our company believes we will ultimately be able to collect from our customers. There is an allowance for uncollectible accounts, which is the amount that our company believes we will not be able to collect from our accounts receivable. So net realizable value, it is, again, the face value of accounts receivable, less an allowance for doubtful accounts. They mention here even carefully screened credit customers sometimes don't pay their bills, and sometimes for reasons that are beyond their control. Things like we just saw with the pandemic. That can throw a monkey wrench in anybody's life. So someone with a 800 credit score can fall behind. It happens. That's life. So allowance for doubtful accounts, it is a company's, again, it just like depreciation, it's an estimate of how much we believe of our receivables we're not going to be able to collect. Usually based off of past history, based off of industry estimates. A number of factors go into coming up with this estimate, and it is just an estimate. So accounts receivable, we believe that out of 50,000, 2,000 will not be collected. How that would be presented on the balance sheet is as follows. We present the full value, full balance of accounts receivable, and the partnering account, which is, again, this is a contra account. So the balance of this allowance for doubtful accounts is going to be contrary, or basically the opposite sign of the accounts receivable. So what you get is the net realizable value of receivables. That is the amount that your company does believe that it will be able to ultimately collect. So that's what's called the allowance method for accounting for uncollectible accounts. You do have to estimate the amount of uncollectible accounts. Two basic methods were produced in this chapter. One was a percentage of revenue, the other was percentage of receivables. So percentage of receivables, or percentage of sales is what we have in our event 3. We use a percentage of revenue. And we use that basically the same percentage all the time, unless we discover that we need to do something to adjust that percentage utilized. So based on past estimates, others in the same industry, we believe there's 2% of our sales will ultimately not be able to be collected in accounts receivable. So we would recognize a uncollectible accounts expense being an income account, an income expense figure, expense account. And we would reduce NRV, net realizable value of accounts receivable for the same. And we'd actually do that through this allowance for doubtful accounts. So if a problem gave you this information and asked you to calculate the net realizable value of receivables, it would be the allowance, the accounts receivable minus the allowance for doubtful accounts. Gives you net realizable value of receivables. So write-off of accounts receivable. These we know customer X is not going to be able to pay us. So we actually take his account receivable completely off of the books. And we also reduce accounts receivable or allowance for doubtful accounts by the same. So we have a little comparison here of what the accounts would look like before and after write-off. The net realizable value will be the same. We will just have we'll adjust our account receivable balance and the allowance for doubtful accounts for the amount of the account written off. So we have a collection. Sometimes it happens that you have an account that's written off that gets recovered. First thing you do is reinstate the account. It's best seen if you split net realizable value into its two accounts. You would have to add in this case, $10 it was, back to accounts receivable and to allowance for doubtful accounts. And then the collection would be the next transaction. And that would be just as usual, increase to cash, decrease to accounts receivable. So period 2, if you use the percentage of sales method, your adjustment is always going to be the amount of sales revenue for the period times the specific percentage given. So we use 2% of revenue. So for every year, our adjustment will be revenue times 2% to come up with the addition to allowance for doubtful accounts. We're calculating the allowance, the uncollectible accounts expense is what percentage of sales does. Percentage of receivables focuses on what should the allowance for doubtful accounts balance be at the end of the period. So we'll look at that now instead. So percent of receivables. It's a better estimate, but you have to back into it. So it focuses on what should allowance for doubtful accounts be at the end of the period. So what we look at is we estimate that 6% of accounts receivable are uncollectible, and that would be our ending balance. And we would adjust from that any balance that is existing in accounts receivable. So aging method is probably about the most commonly used approach. And we did a problem like this, and for each category of number of days past due, we would apply a percentage of likelihood of uncollectibility. And your percentage would increase as the accounts get older. Because as the account gets older, there's more and more and more of a likelihood that we're not going to be able to collect that account. So you would see something like what we see in Exhibit 5.4, which is the top of page 172. And this would be how we would construct our ending balance and allowance for doubtful accounts, allowance for uncollectible accounts. That would be our ending balance. If we had, say, a balance of $2,000 to begin with, then our entry for the year would be the difference between the beginning balance and the ending. So it'd be a $1,760 entry to increase allowance for doubtful accounts and to increase uncollectible accounts expense. So which one is better? Percentage of revenue method is the one called the income statement approach. The percentage of receivables is what's called the balance sheet approach. Either one is fine. Either one works. So either provides an acceptable results. They're both just an estimate, and it's really almost which one is going to be, maybe the most accurate estimate. It takes time, and it takes, trial and tribulation to go through that. So I did a little short part on accounting for notes receivable. So notes receivable, you're going to have a promissory note backing that up. So a written instrument which shows amount owed, the interest rate, the maturity date, and the issue date, any collateral, and the reason for the note. So they go through the characteristics, the parties involved in the note receivable, and how we calculate interest. generally there's going to be an accrual of interest at the end of a period. So interest is, again, principal times rate times time is how interest is calculated. And this often happens where you have interest which will not be received or paid, regardless, based on where you are in the transaction, until the following year. But at the end of the year, the books recognize what portion of that interest is, in this case, receivable. And it was 2 out of 12 months for this problem. Okay, so financial statements. Is this a timing difference? Is all we have here in our interest. We received our cash in year 2. We recognized interest, some in year 1, some in year 2. Washes out exactly the same, regardless of cash method or accrual method, but just how the income is allocated. Okay, so credit card sales, you will not receive the full amount of cash. If you had $1,000 sale, credit card company charges a 5% fee. You will not receive $1,000 cash. You'll receive $1,000 less 5%. In this case, it was $950. So $950 in cash, but we still have $1,000 of revenue. We also have $50 of expense. Okay, so the inventory methods, we had FIFO, we had Lifo, we had average cost. Specific identification is very rarely used. First in, first out. First items purchased are the first items sold. Last in, first out. Most recently purchased items are going to be the first ones sold. So during a period of rising prices, generally your Lifo method is going to give you the highest cost of goods sold and the lowest net income. Weighted average generally falls in between. You take your total cost of inventory, divide that by your total number of units available to get cost of goods sold, multiply by your number of goods sold during the year. Okay. So that's where we'll stop it here. And we actually did not do the multiple layers with multiple quantities. So what we'll be looking at with the exam will be 30 multiple choice questions, be problem-based in nature. Examination will be on Sakai. Again, about a 3-hour time limit as before. And that was way more time than most needed. I think just about everybody didn't need that. So I always recognize the fact that interruptions happen, and that's why I allot more time. So for 3:30, we will have just the examination. We will not meet in class. Then for April 1st, which is Thursday, we'll meet, we'll discuss the exam, and we'll get into our next chapter of material, which will be, let's go into weekly content. Go into our next chapter, which is chapter 7. And chapter 7 will deal with accounting for liabilities. So we'll get into notes payable again. We'll discuss some other topics involved in liabilities. We'll talk about categorization too of liability as a short-term or long-term. And that's what we'll get into week 10. We'll discuss the exam and start our discussion of week of chapter 7. Next exam will cover chapter 7 and chapter 9. And chapter 9, chapter's confused here. Chapter 9 is financial statement analysis. So we'll get into some ratio analysis in chapter 9. And then those 2 chapters, then we'll have another exam in approximately 2 weeks from the one prior. Not approximately, exactly. No, actually it's 2 weeks and 2 days. So that's our material. I will actually, since I'll post the recording of this up to our week 9 folder and then into today's the 325 folder. So if anyone needs to review that, it'll either be an MP4 file or a link to this file uploaded to YouTube. Likely the latter. It'll likely be a YouTube link. So we don't have any questions. We've hit our end of class time over actually by a minute. So we will, please, if you have any questions leading up to the exam, you can email me, course message, whichever you prefer, and do my best to get you on the right path. And we shall see you on Thursday. So hope you all have a good weekend. Bye.